On Wednesday this week, we have the December CPI inflation reading for the UK. And this is an important one for deciding whether we'll see another interest rate rise next month or not, since this is the last consumer inflation release before the Bank of England's monetary policy announcement on the 3rd of February. We also saw the last official data release on the labour market before that decision is going to be made. That data was released this morning, so we can take a look at what that showed us as well. But let's start off by seeing what we expect the inflation data to come out as. Economists that were polled by Reuters gave a forecast for December inflation to hit 5.2%, which would be up from the 5.1% we saw in November and the highest level in 30 years. Food price inflation is likely to have risen in December due to the rise in commodity prices. However, clothing and footwear are likely to have fallen since they had higher than usual prices in December 2020, which is obviously what the annual rate is showing us, 2021 being compared to. Now, in terms of expectations throughout this year, it's thought that inflation could peak at 6% in April, that's headline inflation, and that's when the energy regulator is going to increase its default energy tariff price cap. Now, that 6% inflation rate would be 3 times the Bank of England's 2% target, so it's way above what they'd like to see, and some economists even see it going as high as 7% in April. Now, in terms of the labour market data that came out this morning, there were some positive signs when we look at unemployment, for example, that dropped from 4.2% down to 4.1%, and the redundancy rate also dropped to a record low. The number of job vacancies in the 3 months to December hit a record high of 1.247 million, and even though the rate of vacancies is slowing down, there are still 4.1 openings for every 100 employee jobs, which is the highest ever. However, on the downside, weekly earnings, excluding bonuses, rose at an annual rate of 3.8% in the 3 months to November, which sounds great, but actually means that even just for November alone, there was actually a pay cut in real terms of 1%. And this is the first fall in real wages since July 2020, so more towards the start of the pandemic, or sort of when it started to kick in. So these pay rises aren't actually beating inflation, so they're not as good as they might seem to be if you look at them in isolation. So what does all of this mean for the UK economy? Well, when that regulated price cap for energy rises, it's expected that households will then be facing a 50% increase in their gas bills, unless of course the government does something to reduce that impact in the meantime. So that means consumers will be having to deal with the peak in inflation right at the same time that they're already dealing with a tax hike in April. The Energy Consumer Price Index already increased by an annual rate of 26% back in November, which therefore increased household bills and transport costs, and the annual rate for food prices in November more than doubled from the previous month. So the cost of living is rising, and real wages aren't rising enough to match that. A report by the insurance company Scottish Widows showed that the living costs at the end of 2021 led to the steepest drop in cash availability since the start of 2014. They also see that people are much more pessimistic about their financial future in 2022, which is obviously going to be affecting consumer confidence, and that's going to impact the economy. In fact, an economist at Capital Economics has projected that household disposable income will fall in real terms this year, and this will contribute to a slowdown in economic growth, which they see being at 3.7%. The Bank of England, of course, back in November predicted growth this year of 5%. And the bank's November forecasts showed CPI at 3.5% in 2022, which would then fall to 2.25% next year. But in December, they already said that they're going to raise their estimates for the peak of inflation to 6% in April due to the rise in gas prices. So it's likely that they'll have to push up their full year inflation forecast again on the 3rd of February. However, there are some good signs. It's not all doom and gloom. The UK is due to receive a record number of liquefied natural gas cargoes this month. This has caused the day-ahead natural gas price to drop from its peak of more than £4.50 back in December to £2 last week, although that is still way above where it was in December the previous year when it was at just 50p. A key factor for inflation is still what's happening with global supply chains. For example, in the car market, the microchip shortage limited the production of new cars, which led to the price of second-hand cars rising by 27%. However, PMI did show that prices for input costs were easing for manufacturers. So based on all of this, what can we expect the Bank of England to do on the 3rd of February? Last month, it of course became the first major central bank to raise rates since the pandemic, and the market is currently expecting a further 4 rate hikes this year, which will take the bank rates up to 1.25%. But the main issue for the bank at the moment is not so much what inflation is doing now or what it will do in the coming months, but whether there will be longer term inflation. And that would most likely be driven by wage rises. Along with that wage data that we saw coming out today, we also have anecdotal data. For example, we've seen companies like high street retail group Next announcing they will be increasing wages by an average of 5.4% this year and raising the prices of their clothes by 6% to allow for the rising costs, passing them on to the consumer. And bad news for those of you who are impartial to a cheeky little sausage roll, because Greggs is also increasing prices by 5% to cover their costs for ingredients and their workers. Surveys of manufacturers showed that recent pay increases ranged from 2 to 3%, but in some cases there was a high of a massive 14%, although nearly half of the firms that were surveyed hadn't agreed to any pay increases yet because they were waiting to see what would happen with inflation. Now, when it comes to the central bank, something that we do have to keep in mind is that most of the factors that are driving up inflation at the moment can't actually be controlled by monetary policy. You know, if the Bank of England raises rates aggressively, it's not going to cause gas prices to drop, or it's not going to reduce shipping costs or anything like that. So with this in mind, I'd say right now it's likely that the Bank of England won't deviate from what seems to be the consensus view of what they should do. It's reasonably likely at this point that we will see a rate rise again in the next meeting, but this is nowhere near certain, so there could be surprises either way. But overall, I don't think that they have any grounds yet for any sort of overreaction, and I don't expect to see one. But let me know your thoughts in the comment section down below. This is our first Market Movers Daily of this year, so let me know how the start of your year has gone and what markets you've been keeping an eye on. Don't forget to hit the thumbs up button if you found this interesting or helpful, and check out the videos that we've chosen over here that are relevant to today's topic. Thanks a lot for watching. I'll see you in the next one. Take care, guys.